for anything in particular that you'd like to start with. Just picking up from our previous conversations, any updates you want to share, and I also have this
Um,
spreadsheet open as well.
yeah, I just updated, the new balances. And I did have a question I had written in the notes last time to kind of, so I wouldn't forget. It had to do with where on the spreadsheet should I be plugging the, like my husband gets a 401k and we've never had one before, so I'm like, I don't know the word, um the name for it actually. I don't know. I'd have to ask him again what it's called, but it's pretty much a match, right? So it's like some kind of 401. And I think I wrote, hold on, I may have already written it in the notes. I had asked him at one point what that share is, but I just didn't know where it should go because he gets a, a balance of it and how much is in the account. um, Wait, going to the wrong. Let me go to my notes here.
I think you
Let's
put
see.
8%.
Yeah, where do you see? You see it?
Yeah, in the
Or already
notes.
forgotten where. Okay. So where should I plug that balance in so we can keep track of it? Where does it make sense to do that? Like under income and assets, I'm assuming,
Yeah, definitely
right?
under income and assets where we can label the account. And since
I
it's
think
already
this might be what it is, an SIP, a savings investment plan. Maybe that's what it is.
okay, so you already have it listed. Okay, so we can
Yeah.
put the balance.
Did that
What's
make sense to put it there? Because I think I put that there under total stocks, but I'm like, maybe that doesn't go there. I don't know why I put that there.
Yeah, no, definitely under income assets where it says savings investment plan. We could probably give it a new name. We could probably just title that, the name of his 401k, and
Hmm.
then we would just put the balance, what's in there.
Okay.
In column F, we can put the total contribution amount per month that's going in there. That's
Okay.
because we're already minusing that from the income. So the income that he gets, we're only showing the net take home. What is he, netting
Uh-huh.
each month?
Yeah. Yeah.
That's
Okay.
that's all
We would put
that's
it right
that's
here.
the
Yeah, we
spreadsheet.
would put it in F column just to keep track of it, right? Is what you're saying?
Yeah, yeah.
Okay.
And then over time you can just update the balance on that
Okay.
401k and increasing over time. So
Yeah.
this is a fairly new account.
Yeah. See, when he got out the service in August and he transitioned to a new job. So he has to stay with the company for 3 years. So that's what our plan is in order to keep the match. So that's what our plan is for him to be there for 3 years. But then we want to transition him out to start his own business. So that's
Okay.
where another, taking that, whatever we can do with it, that's at some point, I'll welcome any feedback of like,
Yeah.
how we can transition it or roll it over into something else that makes more sense or, does that make sense?
Oh yeah, yeah. And then how old is he currently?
He is 43.
43. And you're 1 year younger, right?
Yes.
Okay. Okay. So in about 2 to 3 years, no, after 3 years,
Yeah.
transfer to him starting his own business.
Yes.
Gotcha. So we're kind of maximizing all the benefits that he has now.
Right.
The two incomes that he gets with the military pension, VA disability, those are permanent. Those aren't going anywhere,
Those aren't
regardless
going.
of
That's
regardless
right.
of whether he starts a business, works somewhere else. We still get that same amount, correct?
That's correct.
Okay.
And so that disability right now, he's just been, for the past I think this is his second time receiving it this month. He's just putting that in the whole life
Yeah.
and just letting it grow so that, that would hopefully be that seed money that's needed. Because he has an idea of what he wants to do.
Good.
Um,
Good. Good.
we just, it's just all the other little pieces of, having that capital to start it with he's getting certified right now. So, we're still investing currently in order to prepare him to be able to walk away in that 3 year mark time frame.
So the startup is. Do we have an industry, an idea of what you'd like to do there?
Yes, it's going to be in the physical health arena.
Okay. Health and fitness.
Health, yep, and fitness. You got it.
And then you're already in the space you want to be, what you're doing.
Correct.
we've got the education. And remind me the age group again that you are
It's
currently serving.
all currently it's all from K to 12.
This is the 508 part arm.
Yes.
Yeah.
Right.
This is the, what's it called? The PMA, right?
Yes, that's right.
Okay. Education Learning Pod, right?
Hmm. That's right.
And then I just wrote my notes here. I'm not the best notes right here, but it says something on light therapy, holistic learning. These are just some like additional things we're gonna
Yeah, those were like kind of to go off the wellness therapy side. That this is really um
like for the kids,
like
right?
a life, yeah, like a life gym that we're trying to
Mm,
create. So life,
okay.
so that's going to be inclusive and just some other added.
That's the connection with your business and husband's biz in the future.
That's right. So I think it'll overlap, but I
Yeah.
think it'll complement well, and we'll be able to do. But he had a great idea the other day of actually talking to his current organization, the business he works with, and having them bring him on because there's nothing like that on the. It's a really big facility, like a nuclear. What is a nuclear site, and he was just envisioning how the people in that work in the IT field there could probably really benefit from having what he wants to do, like having like a gym on site there, that's physiology,
Mm.
related to help. So I was just like, that's actually a really good, like, not bad thing to pitch to the higher ups at some point, once he gets
Oh yeah.
himself organized, and he said like that would be his dream, to do that. So it
And
and that
that's
go ahead.
permanent business too, because
Yeah.
if you're able to lock in a company, corporate,
Mm-hmm.
you know,
Mm-hmm.
where it's like your one client is all the employees of the company and
Right.
that,
Yeah.
and then as
That
they
would be
bring
awesome.
on new employees, it's like part of the benefits program if they're able to
Yes.
weave
I
it
think
in
that would be
there.
a really good, yeah, sell right there
More
to
and more
bring on.
companies, more and more companies are doing that, where I'm seeing that they're implementing it's like a health benefit program where they
Right.
cover a gym fee or they cover
Mm-hmm.
some sort of health and wellness addition. So that's very, very, very beneficial. Like that. I like
Yeah.
that a lot.
Yeah, I know. And then
Hey Denzel, I
I was
haven't got to say
sorry, this
hi to
is
you.
my husband
Hey,
here.
pleasure to
Crystal
meet you,
talks
man.
talks pretty highly of you. I've watched a couple of your videos. You seem amazing. So thanks for
Yeah.
what you're doing for us, man.
Yeah, absolutely. I'm excited. I'm really looking forward to all the collaborative work we're doing together. I think you're really going to enjoy this video here because I'm recording it on my end, just capturing wife's voice and developing just like a framework here that we can actually revert back to, rewatch it 2 years from now, 3 years from now, and say, "Oh, look at what we said back then and how it's playing out." It's really cool. I've done this. I've been doing this now for 6 years, so I have recorded content 6 years ago with a client, and like they're able to like show it to their friends, their family, just kind of what they've been building, and that really creates a really, really nice ecosystem and accountability, of course. See if we're on track or a little bit off, where we need to pivot, make changes. So you'll enjoy it. Yeah, so I'm excited. Awesome, man. Cool, 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 cool. All right, so outside of that, anything? So yes, we got the 401k contribution thing. That's clear, right? We're locked in. Simple as just documenting the balance, column F, putting the contribution amount, and just like the total monthly that we're contributing plus the 8%. And we'll just monitor that, on a quarterly
Hmm.
basis. It's money we don't plan on really touching or using anytime soon. And then the strategy with that is going to be rolling that over when he goes off on his own, more than likely into some sort of self-directed account, I would think,
Yeah. Yeah.
where we can have a little more control and use of the funds, especially if it's for the business as well.
Hmm.
Another thing that he could just have in his back pocket with the 401k that he has in terms of startup capital. Not only do we have the whole life that's building up, but whatever builds up in the 401k If he comes to the conclusion that I can do way more with this money in my biz than to have that over there, then you can do what's called a rollover business startup called a ROBS, and you're able to take whatever capital that's in a qualified retirement plan, roll that over into the business checking account basically without getting hit with the 10% penalty, right? And that money can be used for his startup. So that is something that you can just kind of have in your back pocket there. It's not something you have to do, but it's something I've had a few clients do in the past where they had, 50K, 75K, 100,000 or more in a 401k that they had no idea what they were earning and what they were paying, costs. It was just money that was sitting there. Did a rollover startup before age 59 and a half, didn't pay the penalty fee. Obviously you still pay the taxes, right, on the money, which would be normal, but no penalty fee, which is pretty great. And then essentially all that capital is freed up in your control, ready to use how you want. So I just wanted to drop that in there so you have that. All right, so outside of that, anything else?
Do you have any questions specifically about, like, because I was trying to fill him in on what your plans were with doing a startup potentially, and the money you're putting aside in the whole life that's going to grow. Okay.
Cool.
That's a great idea to pitch it to the company. So, okay.
The only thing that we need to get on a call with
Our whole life?
Yeah, Mark, right?
Yeah, I remember Mark Willis.
Yeah, so to find out when depositing or paying back the whole life loans we've withdrawn, if there is, which I don't know off the top of my head, if there's an associated interest rate with the loan balance when we start to repay it that we're earning as well, or if it's just a straight 0%. That I don't know, so that's why I'm not sure the value of rapidly paying that back before maximizing the policy. So that's a question I have to get over to.
Does that make sense, Denzel?
Yes. So in this case, we've got, let me take it to the spreadsheet real quick, show that here. So in terms of debts, we've got our primary, we've got this second lien, which is a home equity loan, not a home equity line. One of the things we talked about was being able to eventually acquire a home equity line of credit where we can, do velocity banking and start accelerating, especially that at a faster pace, along with some of the credit card debts. That would be where my focus would be personally, and continuing to max fund the policies first, pay loan interest second, then begin to pay policy loans down third. Now, there is a world, and I do this in my own finance, but it's a matter of building up to it. So mentioning my point earlier where I said, what we're doing now, max fund the policy first. Always max fund first. Like if I'm wrestling between, okay, I have these loans that are really starting to build up and I'm, not the interest. I'm always a fan of max funding because the growth on the total cash value will eventually, right, if managed properly, can create a bit of an offset of what you pay in loan interest shows up in cash value. I'm still paying the loan interest, right, every single year. I don't forego that, and I don't want to let my policy dividends and earnings pay the loan interest. I don't want that. I always want my compound interest to always be uninterrupted, guaranteed tax-free growth, right? So even though I'm paying 5% over here or 6%, whatever my loan rate is, my net ends up being a much lesser rate, and in some cases over a long period of time can be completely offset, right?
Yeah, and I don't know if she's told you this, but the whole life loans that we pull out, they're only a one-time simple interest and they're not reoccurring, meaning it's only that one time that you pay that, and I have to look at what percentage it is, but it's not a monthly interest. I think that furthers your point, is it doesn't make any sense to pay back those loans before we pay the simple interest on them and maximize the policies, then go back to our credit cards and our second mortgage before we probably even attack that loan balance within the whole life.
Correct, because if you were debt free outside of the policy, or debts that weren't high interest cost, because oftentimes I'm looking at cost of money, COM, like where in my finances is costing me the most amount of money. And that's kind of what I want to attack. And typically life insurance policy loans are like tend to be the lowest cost of money to carry, right? So to your point, the amount of money that we have in loans, and as I look on the spreadsheet here, we've got a $52,000 loan and a $38,000 loan. Whatever the interest rate is on that is a typically a set rate for the life of that loan. I've had my policies for 6 years now, and I've never seen the loan interest rate change once I've taken the initial loan, right?
Yep.
That the rate doesn't. If I do a second loan 3 years later and the interest rate changed, maybe that amount might change, but the first loan and the rate that was given has been the same the last 5-6 years that I've had my policy. I haven't seen it change. So with that, if I owe $50,000, a 6% interest rate, all I'm ever going to pay is $3,000 in a year. Now, if I forego paying the loan interest and I let my policy cover the interest, that's where the compounding effect starts to occur. I don't like doing that. Me personally, I like to just handle this loan interest out of pocket, right? So again, we max fund the policy throughout the year. On the anniversary date, you pay the interest, right? Plus fund the policy, and then pay loans later. All right, we always have the intent to pay that off because you want to be able to redeploy that money again. So you don't want to just let it sit there and linger forever. With the cash flow that we have, the income that we got coming in, I think a better use of all this money, like when we look at our total income, if I had that going into a HELOC, what's really cool is the money that you would normally set aside to fund the policy, you can actually have it park in your debt tool, in your line of credit, and it's doing two things. It's paying down the balance, the debt outside of the policy, and then I can turn around and use those same funds to max fund my policy, pay interest, right? It is increasing the cash value over time. And eventually we get to a point where I can now, once I've paid off a lot of the outside debts, got all that cash flow, now I start to pay the loans down, right? And as you pay the loans down, the loan interest goes down, right? Because you are owing less, right? And all that interest that you have been paying and are going to pay in the future eventually shows back up in dividends, cash value dividends, on top of the principal amount that was in there. That's what I like to do personally, and that's what I would like to set up with you guys. Velocity banking helps us get there faster once we get that tool in place.
So, in your experience, you're saying like this, the HELOC is probably the best tool to use to accelerate versus our policy. Like we wouldn't be able to use a policy loans.
You can, you ideally you can. So in a lot of the cases that I work with, typically it's velocity banking first because of speed. I can just go faster, right? You're not able to dump all your income into the policy, pull it out, cover expenses and bills. It's not as efficient. You have to wait multiple days for the money to hit the account, to borrow it out. Whereas a HELOC is more instant transfers of money in, money out, right? So like the volume of interest that you pay at a much lower rate at a faster speed. So you get that speed with velocity. But over time, I always tell my clients this, velocity banking is not a forever strategy, right? It's temporary. It gets a jump start going. It's a great tool to have in our back pocket. It's a great emergency tool that you can tap in. It's a capital tool that we can tap into, but not necessarily something I want to do forever. Eventually, infinite banking with the whole life policies, we wean ourselves off of velocity banking completely and just have the whole life policies that we fund, borrow out, do whatever it is that we want to do with it, pay the loans back, redeploy it again, right? And as the cash value grows even more, and let's say you want the flexibilities of a line of credit, you can actually go to a bank and get what's called a cash value collateral line of credit. And I've had this before on one of my policies, and it's really cool because I can have faster liquidity with a line of credit, and it's completely backed by the policy loan value. So I don't have to worry about the bank closing my line of credit or reducing my line of credit or dramatically increasing my interest rate. The interest rates on cash value lines of credits are going to be lower than most HELOCs, most PLOCs, definitely credit cards and that such. And what's cool is every single year, according to the cash value growth of the policy, you can get a credit line increase every year on the line of credit. That's something that's later, not necessarily now. You need to have at least 100,000, I would say, 75 plus or more in the policy to get those things. And the bigger the cash value, the lesser the interest rate. So if once you get to like 500,000, a million in cash value, you can get like a loan interest rate like 1.5 or like almost 2 points below prime, and it typically like stays like that pretty level, pretty advantageous in that view there. Doesn't always make sense, but sometimes for liquidity purposes it might be a little more ideal. That's something later. I know we spoke just about different banks to be looking at regarding
I'm trying to wrap my head around still like when would this realistically fit in for us to go after getting that HELOC, without going through all the effort and then being like denied, because of various requirements or qualifications. Like, are there certain requirements right off the bat that you're like, okay, you have to have X, Y, and Z before is this more looking like in a year's time of us having our income to debt ratio, be somewhere in our credit score? That makes sense when I'm trying to like get the
yeah.
timeline in my head of when we could go after this.
Yep. So credit score and DTI are like the two main things. Then it's relationship with a bank, preferably a credit union. DTI, the highest I typically see is like 43-45% for approval. So that's what we're coming to the table with, preferably a 720 or higher credit score. Our DTI below 43-45%, and then a relationship with a credit union that we want to do business with. So those are the three things that we come to the table. The rest of the details is all about the features of the HELOC, right? And with a second position home equity line of credit, my favorite things I like to look at when choosing a second position home equity line of credit is going to be some kind of a intro rate, anywhere from 6 to 12 months or longer. It's going to be no annual fees, no closing costs, or very little closing costs, a couple $100, nothing crazy. And then I'll use the word access. It's very accessible, the home equity line of credit, meaning the bank that I go with, when I get this HELOC, I also want to have a majority or all, and typically I like to have all of my income at the same bank that my HELOC is at. So I'll have the HELOC and then I'll have a checking account at the same bank, and they're both linked to each other. So basically all income would land in the checking, and then I manually move 100% of my income right into the HELOC. And then in some cases, some banks will allow you to pay bills directly out of the HELOC. Not all banks do this, but some banks will allow you to pay bills directly out of the HELOC creates a little bit of automation. And then for the things that you can't directly pay out of the HELOC, you just manually move that money right back out into the checking account. And the checking account just serves as a function of expense. It's an expense account, right? With the HELOC, you're replacing the function of a checking account where money is held. Instead of money holding in a checking account, it would just be held in the HELOC, which brings the balance down faster. And then when bills are due, it's either going to come directly out of the HELOC or directly out of the checking account that you just log into your account. It's super easy. You see your mobile app, and you just do a transfer, right? It's okay, over the next 3 to 5 days, I'm probably going to spend $3,000. So let me just transfer $3,000 right out of my HELOC, right into the checking. I only have what I need in the checking. The rest of my money is parked in the HELOC, and that's manipulating the daily interest that I pay on the HELOC, which means more cash flow, right? That you'll have.
Can
So
you give me like a quick like scenario, Denzel, of like just because I don't know how many videos Craig has seen too of velocity banking. Like, so if we were to get what would be a good line of HELOC line to start out with, like 15K or something like that?
in your case, more because of high income. I
Okay.
like to acquire a debt tool that is anywhere from 2 to 3x or more what my monthly net income is, preferably, right?
Uh-huh.
Then it just varies based on how much, if we're talking about HELOCs, it really just depends on how much equity the individual has in their property, right? So in your case, we're saying that the value of your home is 690,000 and we owe 436. I'm just going to use round numbers,
Mm-hmm.
plus the 87,000 that we owe, right? So I'll just round it up and say that we owe 530. So we do 690 minus 530,000. So we have roughly about 160,000 in equity.
Mm-hmm.
Depending on the bank that we go with, I'll use the lowest LTV value, which is usually 70%, right? So the minimum credit line that we could most likely get would be 112,000, right?
Okay.
So that's typically the lowest LTV is 70%, the highest is 100, right? We don't really need to go that high. Some banks, what I've seen is like the lower the LTV that they'll lend on, the lower the interest rate that they'll give you. The higher the LTV, because that's more risk for the bank, right? The
Mm-hmm.
higher the LTV, the more money someone needs, they tack on more points, more interest to that
Mm-hmm.
line of credit. In your case, I always like to be in a position where I don't need the bank, right? I like that, to have that leverage and control where it's like, yeah, I don't need a $160,000 line. Let me just start with 120 or 100 and get the lowest interest rate offer possible, right? So if it's a $112,000 credit line, let's say that's the case, and then we go to this is what I cover in a lot of my videos, but just doing it right here, if I have a credit line of 112,000, I times that by 2/3, and I inform my clients, even though you have a credit line of 112, your max credit line is going to be 74,000, right? Or to be specific, $73,920 is 2/3 of the credit line. That's a leverage capacity rule that I typically follow, that has had tremendous success of all cases, all different numbers. Really helps people understand how much to leverage, when not to leverage. And even if you were max leveraged here, well, you still have a nice gap, right? So if something happened, we've got that 30+% equity space in the credit line. Another reason why I do this is if the value of your home was to drop sporadically because something happened to the economy, well, at least I wasn't over leveraged on my credit limit, right? And even if I was, you still have a gap there, right? Between the total amount of equity in your property versus what you got in a credit line. What a lot of Americans do is they try to get as much equity as they can on top of what they already owe, and we hear the horror stories of people getting HELOCs and then their HELOCs freeze on them. The bank reduces the credit line, or they reduce the revolving accessibility of the line. And that's why a lot of financial influencers are afraid of HELOCs, or they don't understand HELOCs, or they encourage their clients not to get HELOCs. But if people actually knew the power of these things and actually used it properly, you get tremendous benefits from these things. So these are my parameters. You've got your max equity in the home, what we actually would get in terms of credit limit, and then what we actually would use, right, in terms of leveraging. And then to solidify that number, I look at cash flow net per month, times that by 12. And then I say, okay, you can borrow anywhere between those numbers and be okay, right? So you can chunk anywhere between 34, 35,000 as high as 73, 74. When the gap is that far from cash flow, we may not even ever really need to get this high, right? On leverage. And it just depends on what we're doing. In your case, most likely once we acquire the HELOC, we're actually replacing an existing debt, which is the consolidation home equity loan, which has a balance of 87,000, right? So ideally, we want a home equity line of credit more than $87,000, right? So if I went at 112, or if I went a little higher, right? If I did 125,000 times that by 2/3, that's right at 66% leverage. So basically, when you switch from a home equity loan to a home equity line, and you're able to do velocity banking, you instantly start to save money just on the payment that you're making right now in terms of interest costs, right? You start to save money there. You open up that credit line, right? And out the gate, you'll probably be somewhere around 66% owed. So we're not even going to be using the HELOC to leverage for anything else, right? You're going to be doing velocity banking on the tool itself for a few months, get the balance down, and then we'll start to move other debts into the line of credit. We'll probably start with the credit cards that we have, and then after that, it would just be a matter of bringing the HELOC to zero. We would stop, and then we go back to the policies, because the policies is probably going to be at a lower interest cost than the HELOC for sure. So I don't want to use my HELOC to try to pay off my policy loans. That wouldn't make sense, because you're doing simple interest versus simple interest. So that doesn't make sense, right? So you would actually stop velocity, then we turn on infinite banking, send our cash flow directly to the policy, paying it down, then redeploying it to pay off, say, your cars, or to start accelerating the primary mortgage, right? Things like that we can look into. Does that help? Does that give like a nice little idea framework here?
Yeah, absolutely.
Perfect. Any other questions around that?
Nope, I'm just glad Craig's brain is here because he can later break all this down where I'm like,
Yeah.
I'm following. I'm surprised I'm following, all this, but I know he's getting it like, he's like nodding, like, yep, that makes sense. That makes sense. And so
Yes.
later when it's all out of my brain, when I brain dumped it, I'll ask him again, like, okay, so do you remember like what is our first
Right.
step? So I'm glad we have this video.
Yeah.
This is helpful.
And in terms of
In
timeline,
your experience, sorry to cut you off. I just have one quick question. So, with the second mortgage on the house, is that ever a challenge in acquiring a HELOC, or I mean, is it a parameter that some banks kind of, I'm not so sure, or does that not usually play a role because we have enough equity in our?
Because you have enough equity in your home and we've got good income, we've got good cash flow, we would just need to know what our actual DTI and credit score is across 3 bureaus. The banks like it, especially, your who's your home equity loan with?
Rocket Mortgage, but I think
Boom.
we just got a
So
message sent that they were selling it, if I'm not mistaken.
yeah, because that's what they do, right? So
Yeah.
you write with one bank, so Rocket Mortgage, boom. They're a huge organization. They're nationwide, right?
Mm-hmm.
And then
Mm-hmm.
they'll sell your stuff to someone else, and someone else takes it over, and then someone else takes it over, right? And that just kind of like happens.
Yeah.
If you take the debt you owe with Rocket Mortgage and go to a local credit union in your state with a bank where the only clients that bank has are the residents of that state,
Yeah, I
that
understand
bank,
where you're going.
yeah,
You don't even
that,
have to explain it any further. They want your money.
yeah. And they're happy because you're a resident of that state. They're already giving a benefit. They're like, hey, come with us because we'll consolidate that debt with us, and you get a better interest rate and all that stuff. We just have to speak their language. I tell my clients, listen, you're not just going to go up to Georgia's credit union and say, I'd like to do velocity banking with a home equity line of credit. We're not going to say those as kind of like red flags because they're going to be like, what is that? But it's more so, hey, I'm looking to consolidate some debt, looking to reduce my expenses, increase cash flow, build my credit, maybe do some repairs around the home. And I was looking at your home equity line of credit, and I think it's a much better option than what I currently have. And when you're transparent and you give them all the details, here's what I currently owe, the value of my home, this is the interest rate that I have, and you build a relationship with the person that is a part of the HELOC department at that specific credit union, and her name is Tammy or John, right? And you just build that relationship is key. At the end of the day, it is a human that does have to sign off on a couple things, and then they run it through the algorithm. Sometimes they put notes, right? They might say, push this one through, please, right, to the underwriters. Little things like that happen, and that sort of speeds up the process or just makes it smoother, honestly. And so as long as we do all those things in advance, and you're really taking out the guessing work. And I really like building a relationship with someone at that specific branch, at that specific credit union, because chances are they'll give me all the details. They'll say, yeah, we typically want to see this much DTI, this credit score. We need you to be a member of the bank, open up a checking account, savings, some money in, right? And then about 30 days or so to actually get the line. Good, good, good.
Mhm.
Anything else?
Yeah, one question. I think one of our challenges has been that Craig's identity was stolen like a year ago, and some credit was opened, and he's been,
Right.
it's been a nightmare, and it has affected his credit score. So my thoughts are like, would we benefit from doing like a credit repair boost, something, to like accelerate, or is this just like a timing game that we're gonna have to wait for that naturally to repair itself, which seems like could take long. I don't know. Because this has never happened to us.
Yeah, it would be interesting to, once we find the bank that we want to work with, that we tell them all that up front
Mm-hmm.
and see what they might recommend. To be like, that's not going to be a problem. They might say something like that.
Mm-hmm.
Um, they might say, yep, we want to maybe fix that a little bit. And I don't know if it's necessarily going through credit repair. It might just be a matter of just making sure that certain things are now removed off your
Mm-hmm.
credit report. That does require manual effort. I know there are companies out there that say, hey, we'll do this for you and we'll, remove these things. But at the end of the day, it has to actually be you that goes to the bureaus, contacts them, fill out the disputes to remove certain things that should not be on my credit report. So I think there's two components. There's identity theft and fraud that occurs,
Mm-hmm.
and then getting some kind of identity theft protection would definitely be like one thing I would want to do. And then there's the repaired or recovery process
Mm-hmm.
of like, okay, this is what happened. What's left showing on my TransUnion, Equifax, Experian? What's still on here that's not true, right? And then it's a matter of communicating with each and every one of them to remove it. And if I'm not mistaken, when you do one, maybe all follow suit. Could be wrong there,
Mm-hmm.
not the best. But before you pay anyone to kind of do it, I would maybe just consult with someone, just kind of get the facts. Because some companies are like, yeah, pay us this, and then you're paying them for 9 months and nothing really happened, right? It's kind of weird. I've had that happen a lot with clients when they use like Lexington Law, like one of these big credit repair companies. There's been a lot of laws that have changed and updated where it puts it more on the person, the individual, where it gives them the empowerment to fix their credit themselves, right? And submit the stuff accordingly.
Okay.
Cool. Yeah. So yeah, the timing definitely there. But from an equity standpoint, from an income standpoint, we're pretty much positioned. We just need to find the right bank. All right. And you're in
Okay.
Georgia, right?
Yeah.
Okay. So that's where I start. I look at credit unions in Georgia. I know there's Georgia State Credit Union. And you can even look by your city. You look at the narrow, like within 25 miles, within 10 miles approach. I can put a little list together of different banks that I know clients in Georgia have used.
And like, what's your thoughts on like Navy Federal? Since I already have a relationship, it is a more of a larger bank, so you don't recommend
Yeah.
something. Though we have a branch down the street from Navy Fed or on the corner, it's still not something you'd recommend. You still need to stick with a state specific.
Yeah, I prefer to stick with state, and then maybe going federal with like a Navy Fed or a Penn Fed or like one of those military banks, because you have a military bank background. There are some military credit unions out there that are nationwide and some that are state specific where you can probably get like a really good deal. Although with Navy Fed, their home equity lines of credits don't have the best reputation. Their rates tend to be high on the HELOCs. And then during COVID, they did remove their HELOCs as a product for a period of time. They closed it. So they weren't accepting new applicants. So it's
So I think really what you're saying, Denzel, is you're saying go with somebody local because they have a smaller
correct.
people in that bank and they're looking for more clients. Because someone like Navy Fed is not.
Yeah. Where I like Navy Fed is their credit cards. Navy Fed has some really cool credit cards with 0% offers and 0% balance transfer fees. So you could kind of do like a HELOC and credit card combined strategy. And I would say Navy Fed does thrive there because they tend to give people big credit lines. And again, there's a give and take there. As nice as that seems, as much as they're giving out today, they can also pull whenever they want. And there's just been a lot of poor reputation of what's kind of happened with Navy Fed over the years. It's supposed to be for military families only, but there's been a lot of content creators in my space, in the finance space, that sort of put content out that gets people that aren't associated with military families. Somehow they get approved and they get these big credit lines and then they abuse them, and it can create a little bit of a mess that I may not want to participate in. So that's why I inform clients to that as well. But still, their credit cards are cool.
Awesome.
Yep. Okay, so we're pretty clear on HELOC. It's just a matter of timing. No need to rush this. We've got a good strategy going on already. So, we're good. This is like the planning and prepping stage.
Okay,
Any other
so
question around here?
I think it gives me a direction. Now that he's sat here, I think he's gonna be like, I think he, the daunting task of getting the credit thing worked through, is probably something easy for him to like kind of just bury his head in the sand. But I think this is going to help him to kind of see like, okay, there's a purpose, like, and yeah, it's going to require some work, on the front end. But I think now we could probably see, I think this will help us to kind of get the gears going for, just getting it started so that we can see, because sometimes it's not, I know it seems more overwhelming when you just don't know what it's all gonna,
Yeah.
like entail. I think this gives us a direction so that we can say like, okay, maybe a year from now, even maybe less, like once we delve in, maybe it's not as bad, and we'll be able to like move forward with the HELOC, because I think then I'm gonna get excited at the acceleration, of things going.
Yes, absolutely.
Yeah.
Okay, great. So I feel like we can close that chapter there. That's something that we'll just work on in time. What we're doing
Okay.
with our money over here is good. We're spending less than what we make. We're cash flow positive. I always like to see that. We're funding assets. We're funding policies. We're doing all the right things there. Continue to
Yeah.
max fund. Make sure you pay the interest out of pocket. Don't let your policy pay the interest. We could pay the loans
Yeah.
later. The cost of money to carry those loans aren't as much as the other debts that we have going on. Okay.
Mm-hmm. Mm-hmm.
Couple of things right here I think you're really going to like. I've done this before. This is just fun to run the math on, and really also gives clear direction where we're going, where we want to go, and where we want to, how we can have our money line up with where we're trying to go, right?
Mm.
So
I like that.
couple different numbers here. We've got the FI number. It stands for financial independence number. We've got the financial freedom number, right? The financial freedom number is always higher than your financial independence number. To answer it, what is financial independence? My definition is having enough guaranteed, or as close to guaranteed as possible, of income that is equal to or a little bit more than your current lifestyle, your current cost of living. And once you have that number, that basically is one of the phases or steps that you're on the right progress to financial freedom. All right.
Mm-hmm.
So we could easily declare what that number is in terms of financial independence, or we can go off of today's cost of living, right? We can include debt or not. So you could say, well, if I was debt free, then my cost of living is only this, right? So when I look at the spreadsheet, we've got $5,575 of debt obligations. If that didn't exist, then my financial independence number is really only about $9,000.
Mm-hmm.
So we could say financial independence, 9K to as high as that exact number, 14,222. And when we look at current income today, we see where we're at. We see how far we are. We could say, well, we've got $8,700 of guaranteed income right now, military pension and monthly VA disability. And we're only 43, 42 years old. The ideal time frame for financial independence, in my opinion, would be getting there 5 to 10 years before I retire, right? So, or I should say, before normal retirement age, which is anywhere from 59 to 67 years old. 67 is full retirement according to Social Security income standards, right? And then 59 and a half is according to retirement plans. That's when you can actually start pulling from those accounts. So 5 to 10 years before that, in your case, is pretty much by 50, right? Or 53. Okay. Well, we've got 87 so far, and the first number is 9K. We're only $300 off, right? And from the
Not too bad.
from the $14,000 number, about 5, 6 off.
Yeah.
Not too difficult to
So
get there.
that means like getting more passive income as guaranteed.
As
That would.
guaranteed, correct. And there's
Yeah.
only 3 vehicles in the United States that have the word guaranteed in the contract. And that's going to be annuities, Social Security, and pension plans. Those are the only guaranteed forms of income. We could also say like VA, right? But that's kind of like a Social Security benefit. So it kind of wrap that together. So in your family's case, we have a pension already that exists from the military. That's going to pay for life. We have a VA disability. That's going to pay for life. By 62 to 67, the both of you will be able to get Social Security, right? Later on. So the only thing that's left are annuities, right? An annuity is basically a customized pension plan that you're able to fund, and it'll produce a guaranteed lifetime income stream for life. Now, what's interesting though is at your current ages, it does not make sense, in my opinion, to buy any kind of annuity right now, where we're much better off putting free cash flow in would definitely be the whole life policies, and putting our money in active and passive vehicles, right? Active vehicles, education biz, startup biz, health and fitness. That's our active income, and then the work income that husband currently has. That's great, right? Passive income, ideally, for me, is figuring out how to turn the things that you love to do and monetize and create some sort of passive income stream in the education space, in the health and fitness space. That's where my mind is going first. Most financial planners and influencers will say things like, get your 401k, your Roth IRA, your brokerage accounts, your HSA. And those are all good. I like those. But for me, I believe that if I put $1 in this education biz for you, or if I put $1 in his health and fitness, the chances of me getting $2 back is much higher than if I would have put $1 in the retirement account and only earn 6 to 8%, let's say, maybe 10. I'd rather earn a whole dollar, 100% return, than 6 cents, 8 cents on the dollar. Does that make sense? So between ages 43, 42, all the way to 55 or sooner, where and you can reject everything I'm saying here as like a more of like a dialogue, right? To sort of challenge, so that we just run these ideas. I don't want to be just giving you something and then you go off that. I'd rather us have like really good dialogue here. What works best for you, if you're in alignment with it, or if you want to question, one or two things. So feel free to pretty much stop me at any time as I'm sort of explaining my position here. So we've got guaranteed income that will grow over time. And the idea in my mind is that by the time I retire or in retirement, I want to have enough guaranteed income that at least covers my cost of living and will stay ahead of inflation. In your case, we're pretty much there. We're almost there, right? If you were debt free, we're there, right? Because cost of living is $8,647.74, and that is including saving in the whole life policies. So that's including savings. When you minus savings, you're well more than there. So just keep that in mind. And then we're also including giving in that, right? So we've got a lot of room to work with in that regard. So that's pretty cool that we're pretty much active income. We're going to be actively working in these things. And what's really cool is the longevity of this biz and health and fitness. There's other couples out there in the world. There's other businesses out there in the world where the founders are well in their 60s and 70s, still doing this, right? In some sort of education capacity, some sort of health and fitness. Like they're still operating, maybe not as much as they were doing when they were 40, right? Or 50. But this isn't like a sport, right? Where the longevity of it is short. So that's what's really cool about what you're in,
Mm-hmm. Mm-hmm.
is that you could very realistically keep doing this well into your 60s. And what's also very important is that when we do reach retirement, that we understand, what retirement really means for you. And I think, for me, again, you can reject or question it, whether it's rediscovering or
Mm-hmm.
continuing
Yeah.
to operate in your purpose in retirement.
Mm-hmm.
And so what I've witnessed is, in our working and accumulation years, which is what you're in right now, we're actually doing the purpose. We're building the purpose, right? You're in it. Then it gets so big that you have to actually like lift yourself out of the activity of it, sort of delegate and replace or duplicate yourself in certain roles so that it can
Mm-hmm.
keep operating without you. And then you get to a certain age, retirement, 59, 67, where you're now in a position where you can be more philanthropic, you can contribute more from a financial standpoint, and also maybe even from a time standpoint. Because during the accumulation years, maybe you weren't really able to like coach someone that was 29 years old that you wanted to mentor, right? But as you get older, you may have a desire to mentor someone in one of these different businesses. Maybe husband might have a desire, you know, uh, picks up a certain employee, a young guy or young individual that has, a lot of fire, that someone that loves your mission as much as you do and can almost pass the torch. That's where I think in retirement, and then 5 to 10 years before retirement, you're doing that succession planning, right? So that's retirement for me, and for you, you get to really define it. And the better we do at defining it early on, usually the better, right? So taking the active income that we make today and just throwing it right back into the business that creates monetization and passive income is as close to guaranteed as you can get in terms of income, in my opinion. Then you've got the different financial vehicles that exist that are just going to make total financial sense. You've already got a few of them, right? You've got your retirement accounts, you've got the whole life policies. Maybe you get more along the way. We put more and more policies on family members of the household, right? And that continues to build more value as we continue to remove key risk. And this is another like huge thing not a whole lot of people talk about, removing key risk. If all we did was just go one by one of all the key risk of life, and we had insurance products, financial products that simply covered and paid for those risks, you are removing the stress and the question of, will I have enough money to live off in retirement? Will my money outlive me, or will will I outlive my money? And just becomes a percentage game at that point. But if we can remove 99%, almost 100 of all key risks, then your chances of succeeding are just way higher. And it also gives you a unique perspective on how you treat the different money piles that you have. It doesn't even require you to take so much risk with your money. And that's what a lot of people that get closer and closer to retirement, they're like, oh shoot, I need to take more risk because, I'm only 5 to 10 years out from retirement. But if we actually just looked at what are the key risks, dying too soon, long-term care, injuries, right? Permanent types of injuries, health, cash flow, debt, obligation. It's like, well, let's just go one by one. What we don't need in our life, and then understand what does it cost to live our lifestyle. We're going to get to that number, the financial freedom number, and we just have our money direct toward that. In so many cases, you don't have to take certain risk with certain dollars, and then we can just keep doing the thing that we're purposed to do on this planet, right? Your ability to create value in the marketplace, get paid abundantly for it, right? So that's just a little framework there that I have for myself, what I've picked up over the last 6 years, reading certain books, listening to other successful people. And for me, it's so clear, it makes perfect sense. And it's not as hard as so many people make it out to be, especially when we do proper planning like this. So financial independence number, anywhere from 9 to 14,000. We're only a couple $100 off from that 9K number. The financial freedom number is very flexible there. What I have had other clients do in this exercise is we create another financial spreadsheet and we just go to the living expense column and we just put everything that we would like to do in a position of financial freedom, and we start putting a cost to everything, right? So let me see if I can pull one up for you. Then from a financial freedom standpoint, this is more of a fun number. I like to inject fun in my financial strategies and stuff. And so the
Yeah.
exercise that I would have you and your husband do, and I've done this with other clients, is you'll fill out another spreadsheet, or you could just copy the living expense tab on the
Okay.
current spreadsheet, like just duplicate another one,
Okay.
have two living expense, and then we'll just call it financial freedom lifestyle. And then one by one, you'll just go through everything that the both of you would like to do in that desired point in life where you can say, hey, we're financially free, money's no longer a problem, but all we're going to do now is just calculate, what does our financial freedom lifestyle look like? And everybody's number is different, right? So I had another client where her number was like $22,000 a month was her financial freedom lifestyle. Someone else was like 40,000, right? But each of them went through exactly what it would cost, or the estimated cost to have these specific things, right? So I had one lady where, part of her desire was to have a personal driver, a personal chef, massage and facials every month, and 2 properties, one property in one state and another property in another state, and be able to go back and forth, and then a property in Jamaica, right? And I said, okay, I want you to look up what is the average, flights costs and how many times. And we just went through every single thing and we saw what the number was. And then once I get that number, I then simply do a cost of living calculation of 3 or 4%. And I just say, all right, if that financial freedom lifestyle today costs $25,000 a month, and our goal is to get there within the next 10 years or less, then I just do a cost of living adjustment 10 years out, and then it'll tell me roughly what that cost will be 10 years from now, right? So that's what we'll do together. Sort of the action step coming off of this call is that's how we'll figure out our financial freedom number. We could give a guess, right? We could give a guess right now, and usually what I tell clients is my best guess is always 10x what my current income is today, right? So if I'm making $17,138 a month times 10, if I was bringing in $171,380 a month, that's 10x where I'm currently at. And so let's just say that's the top number. And then we just reverse engineer and see, well, what does it actually cost to live the lifestyle you actually desire, not what TV, society, friends, family say. It's like just you and husband. Like, hey, we just sit down, we go through this, allow yourself to just think like a kid, right? You're not thinking, oh, that's too much or this. Like, don't let any of those thoughts come in. Just be a kid. Both of you be a kid, and just go through what it is that you want to be able to do. Think about what you want to do. Think about what you want to be able to give, and who you want to be able to impact, what kind of experiences you want to have. Like, just go through the whole thing. I went through it for myself. My number is about $83,000 to $85,000 a month is what it would cost to live the lifestyle that I desire. And I just look at where I'm at today and I just see what the gap is. And I say,
Mm-hmm.
okay, here's where I'm at. This is my gap. What do I need to do to get here and bring that timeline sooner rather than later? And
Okay.
for me, I like it because it takes the emotion out of it. It takes the stress out of it. For me, I don't know, other people might stress just thinking about it, which I get. I get it because it's something you're not accustomed to doing. But the more you do it, you get comfortable with it. And I know that with people of faith, sometimes the spirit of contentment almost works against a believer
Right.
when you're trying to dream big and dream of God's potential over your life. When you're able to just think like a kid, no fears, no responsibilities, you're part of a royal family, right? And just allow the
Yeah.
the numbers to flow and just look at the stuff. Let's see what the number comes out to. Chances are it's going to be way less than this number, usually.
Mm-hmm.
So that's why I say that. I'm like, look, here's like 10x where you're currently at today. And I just want you to personally go through it one by one by one. And let's see what that does, right? Just to give us a little bit of a framework. That's all we're doing is just building frameworks.
Yeah. Okay. That
Awesome.
sounds like fun.
Yeah, it is. It really is. When you actually go through, you're like, oh, wow, it only costs this much to have this, or, oh, okay, it costs that much to have that, you know? And it's really interesting when you think about it. And then you look at how far you're off from it. And in so many cases, we're not that far off, you know? And that really gives us the confidence, like, okay, we're on a good path here, you know? You don't have to hustle. You don't have to hustle, right? The hustle culture to like get there. You just
Strive.
you just need to operate in your gift more and just do that and it'll come.
Yeah.
As for active and passive, that's just kind of breaking down where we're currently at today. So we've got active income of the $8,438. That's just husband's income, right?
Right.
Okay. For PMA that you have, we have clients, right, already?
Yes. It's just so sporadic right now. It comes like, I don't even want to say like I'm always getting paid. Like on good months, when our expenses, our overhead, like, when it just works out that we're in the black, right now we're just paying, me and the other co-founder, we get paid $750 a month, each of us, so I'm just putting that money towards like investment for myself, like, paying for you and paying for any other like workshops or anything like that, like for skills, like, so I kind of just take that money and just put it into something like that will help me grow my skill set, or some other, so I don't even count it. Does that make sense? Which I don't know if you recommend doing it, but like we had a bad month, like where we lost some of our students, so we didn't pay ourselves that month, or like the hurricane closed us down for a month, so we didn't charge everybody, so we didn't get paid that month. So if it's just kind of where we're at right now.
Yeah.
Hopefully like 2025, I'm claiming that it's going to be, when we're done with our training for the school and we open our doors officially, like as a Apogee campus, that we're believing for good things for acceleration. So
And you're running this out of your home or
we are, but we're actively looking for a location for
a
next year.
location?
So
Right. Okay.
yeah, that's our challenge, our
I
problem to solve.
I think it'd be really great if we separated that business in a spreadsheet of itself, just so that we can record the average monthly expense cost, what we're bringing in from it. Would you say that from the 17,138 that husband brings in, is any of that money going into the biz, or is it pretty much?
Oh yeah, it has been. Yeah, we've done some, I don't know if we would call it what, like an equity something, I forget the term, but like, he paid for the affiliation fee. Like 6 months ago, that was $12,000. So we're doing donations or investments into the business, I guess is what. Yeah.
Yeah. So in terms of our cash flow on a monthly basis, the cash flow, we would say, is going toward that. And in terms of debt elimination, we've just been paying the monthly bills on everything, keeping everything current. Is that an accurate thing to say?
So rephrase that. You're saying for rooted, you're saying is any of the cash flow, is any of our personal cash flow going into it on a monthly basis right now?
Is any of this cash flow going toward debt pay down, or are we just making the monthly minimum payments on all our
Oh,
debt?
for our we're making an extra payment on one of the vehicles right now out of the
Okay.
cash flow. And these past 2 months, we have not been able to use that cash flow towards debt elimination. But starting January, that's the goal is to start
Right.
increasing that.
Yeah, because on the
Debt payment.
spreadsheet I had wrote were the next most attractive debts to eliminate,
Mm-hmm.
right?
Yeah.
And we could start with the Mercedes because it's the lower balance,
Yeah.
whereas the credit card balances were all at like lower interest rates, and then we did the cash flow index, as you can see on the side there. We
Right.
did cash flow index. Let me all these high numbers here. All right, that's cash flow index, and then the vehicles were the
Yeah.
smallest numbers.
Mm-hmm.
So what you're saying is, yep, the past 2 months, majority of the cash flow plus some liquidity maybe from savings, because you said 12 grand went toward a fee for the business.
That's correct. Yeah.
Right. And then would you say starting next month, go back to like a set number?
Yeah, but looking at the numbers too, I'm not sure if you remember when I said that Craig was going to take that disability chunk that's 4,000. So that has come out of the equation for being able to like pay down um, debt as quickly as I was hoping to, because he's really wanting to put that aside in the whole life and letting that grow for his investment. So that's where he's at, right now. I'm not sure if that will change, like in the upcoming months, where he's like, as it grows, he's like, let's just chunk it towards a debt. But
Mm-hmm.
for right now, 4,000 of that 17 is going towards investment to grow for his business startup.
100% of it, or
The 4,000, yeah, the 4,000, yeah,
on a monthly basis?
yeah.
So let's look at, because I'm looking at how much we can actually pay into the policy. I think we're cut off at a certain point, right? So with
Right. So that's a good point. Like I still have to, well, we're getting ready soon to have to fund them again before we know it. Like when is it? It's like March, April. So we still have some room in there in both of our policies. And not much on his, I don't think, but on mine there's still some room. And then it's just like getting ready to do it again come March and April timeframes is when we typically have to.
Yeah. So I want to kind of write that out here. So I'm with your policy, I wrote 1083.33. I think with yours, we're able to pay 13,000 a year.
I always remember the amount, like 18K is what we can put in there. I need to get these. He has yet to respond back to me, so
Oh,
I need to
right. We're still waiting on
follow
the
up.
agent. Gotcha. Yeah, because
Yeah,
I
I
wrote
need to follow
7,081.51 is
because that's the pre. Yeah.
your base,
Oh, base. Yeah.
right? Got to look at husband's base. No, he's doing 1708.33. I think he's able to pay in 20,000 total. That's what I have here. And then for the kids, it's 1,511.65. That's what I have here. So I remember you had sent a screenshot with Foresters. 14,500 PUA. Well, paid up additions. That's your policy. 14.5. Yeah. So we'll get clarity on that. We're still waiting on the agent
Yeah.
to get us those
Making
details.
an. Okay. Follow up.
We'll try to hit him up again.
Mm-hmm.
But 14.5. So if I said 14.5 plus premium. So either your max is like 21.5 or it might be like 18, as you said. Husband's
Yeah.
is probably a little higher, like 20 or 25, something like that. And if I'm not mistaken, we're basically sending $4,000 a month spread over both policies on a monthly
Yeah.
basis. Just like
Yeah.
funding it to the max. Got it. Yeah. That I'm in agreement with. I
Okay.
like that. I think that's great. I think, yeah, let's, keep doing that. Because that's
Yeah.
part of our expense anyways. And
Right.
it's like on top of that, we still have this cash flow here. All right, so I've already accounted for a certain amount of funding from our living expense, and then we're still having this positive cash flow. That positive cash flow, for the most part, is going to your business.
It has been. It's
Yeah,
not.
not always.
Yeah.
Yeah,
Not always. And I think we're stable right now. So.
stable, right. And so when it doesn't go, then we're taking that and sending extra money toward the car pay down, let's just
Yeah.
say, toward the Mercedes.
Yeah.
Gotcha.
At a minimum, I'm making an extra payment like the past 2 months.
At the
So
minimum.
hopefully I can increase that in January.
Okay. Yeah, and
And
at
get that.
that rate, just paying an extra payment on, let's say, the Mercedes, that's gonna be paid off 6-month time frame, right? Because if I'm sending
Yeah.
1,000, eight. Say 8 months. That's very realistic to be able to be done with that. And then I would say by the time we're ready to go with the HELOC is where we would shift from paying down the car to actually paying down the home equity line of credit itself, because we would have consolidated
Right.
the consolidation home equity loan, which I still don't know the interest rate on that.
On the home equity loan? Oh, okay. Let me write home equity loan.
No, the payment's 1051.
That was you said the interest rate, right?
Yeah,
Interest
just the
rate.
interest rate. I got the monthly and then the balance.
Okay. I got some homework.
Yeah. Any other questions?
I don't think so.
Cool. So we'll have another discussion, just kind of follow up on the 508. Would love to talk to you just like on big goals here with the education part. If there's any desire in the content creation space, social media space, we can collaborate on that. More than happy
That'd
to.
be awesome.
I think there's a world there of some sort of
Yeah.
collaboration.
Yes.
Let's see. Yeah, so I think we covered everything. And then as it relates to passive income, I want to be able to have a dedicated discussion on outside of financial products, such as whole life, such as an HSA account, such as a 401k or brokerage account, these are things that we'll just have and you'll contribute to them throughout now all the way to retirement and even afterwards. But I think being able to figure out what would be a passive income stream within this education biz. Some of the things that come to mind for me, because I'm also in the education space, courses, right? Online courses, some kind of subscription that's like you do the work once, people pay, and it produces a stream of income consistently. It's work you don't have to continue to do. Monetization of social media content.
What do you mean by that? What does that look like?
An example would be my YouTube channel. I now have 1,000 plus videos on the channel, and those videos pay me some money every single month. And I only did the video once, right?
Yeah.
Did the video once, I posted it, and I get paid forever on that one video, right?
Okay.
And I can YouTube channel give you an idea just how powerful that is. The difference between your education biz and mine is I'm just documenting it, right? And then more people are seeing it. So if we took it from that perspective, not about how many views you could have and how viral you can go and all that, but if we just look at it from the perspective of what would it look like to document all of this, and what could that potentially pay? All right, so let me give you an idea. Got my screen here. So see that number at the top? So that's the total amount of revenue that my YouTube channel has made December 15, 2018 to now. basically. And it's not a whole lot of money, right? I mean, if I took 67,746.38, divided it by 6 years, that's about $11,300 on an annual basis. Not a whole lot of money, but 11,300 divided by 12 is a passive income of $941 a month.
Yeah.
Not terrible.
No, not at all.
And if we looked into the mechanics of this, we could say, okay, this one video, how to use a line of credit, made $1,000 and $1,046.04. This one video, how to pay off debt with a HELOC, has made a total of $963. What to do before velocity banking, $960, right? And just keeps going, you know, it can go to see more. And then in my head, I'm just like, okay, what would it look like if I just spent the next 10, 20, 30, 40 years just making videos that people are searching for and made a couple of dollars off of each one of those videos and just have it compound over a long period of time. And
In
so
theory, it sounds great. I just struggle with like I'm like I either need really just creative ideas of like how would our model work to like document, you know? That's the piece I can't wrap my head around, but
yeah,
I think I'm thinking in the box still and not out of the box.
yeah, and that's okay, right? So there's no rush to that, because as passionate as I am encouraging people to get on social media, I also let my audience and let my clients and even you know that it took me 4 years before I ever posted my first video. You know?
Yeah.
So giving it that time that it needs, allowing us to think, that's just one way to create a passive income within what we're already doing, right?
Right.
Maybe there's merch down the line, who knows? But a curriculum, right? Where it's like,
Yeah.
what if you put a curriculum together that someone else that has a business similar to yours in another state wants to adopt, and they're like, hey, I see what you're doing. Could you coach me? Is there a curriculum I could use? And you say, here you go. Here's how much my curriculum costs. And you almost white label that curriculum for that other business, and they put their logo on it, their branding. And so it's things like that where it's like you do the work once and you're able to monetize the work that you do. Maybe it's a book. Maybe eventually, after working with so many kids, you write a book.
Actually, I do feel like God kind of put that in my head the other day. It's like you can write a series of like children's books that have to do with their with identity, you know, kingdom identity. And I was like, okay. I was like, that's coming out of left field because you know. But I was like, because I've been searching for some of them for my own children, you know, and I'm not finding that many. So that just had my juices flowing. So I'm like, I've never thought that I would write a book, but here we are. Maybe
Here we
that's in the
are.
future.
Exactly. So thinking is the hardest work most people never do, right?
Mm-hmm.
So us taking the time like this, having a deep, deep discussion, documenting it, saying, okay, here are the ideas. Here are the passive income ideas within the thing that I'm already doing. It blows my mind, because it's like I don't have to spend any new energy trying to figure out how to make passive income in the crypto space, in the stock market, in real estate, although those could be things that we eventually do.
Yeah.
But like when you look at this, it's like there's no new work or no new thinking that needs to be done. It's either a matter of documentation through video or written word, book, and then some form of marketing so that people can see it. And then say, yep, that's what I want. Boom. Okay, that now makes the business a couple $100 a month on top of the activity that we're bringing in. I look forward to seeing the fruit, you know, come out of that. That's going to be fun.
Yeah, that'll be fun. I can't wait.
Okay.
Yay.
Beautiful. I think we're good here. We can close this out.